Well, interest rates are on a rocky road again, y'all. A lot of turmoil this week. Let's get into it and we'll go through the reasons why. Today is the 12th of October, Thursday. Hope you were doing well. We are seeing interest rates kind of all over the map over the last 5 days. We've seen pretty wild swings, and I think that's to be expected given what's really happening around the world right now. So we did get two huge inflation reports this week. We got producer price index yesterday. We got consumer price index today. Both of them are hotter than expected. By themselves, either of these reports would have moved interest rates significantly higher. And in fact, interest rates are moving higher. That said, they are not moving, frankly, as high as we would have expected given these reports both coming in stronger than expected. And the reason for that really is the geopolitical unrest that we're seeing in the Mideast with a war between Israel and Hamas, the possibility of that war expanding into Syria and into Lebanon. Those are rattling the markets. It is adding some uncertainty, and that uncertainty generally generates some degree of flight to safety, meaning that folks want to park their money someplace safe, like a fixed income security, like a mortgage bond or a treasury note, in order to safeguard it while they see how things hang out on the world stage. So we have those two things working in concert with each other. You have higher inflation that would have taken interest rates significantly higher. You have this geopolitically unrest that is tempering some of the sting that these reports would have otherwise given us. So let's get into the numbers. Consumer price index was up 3.7%. It was at 3.6% in the last, or forecasted year over year. So we're up just a bit. That report was largely in line with expectations. Frankly, it is in line with expectations if you take out the shelter component. The biggest mover inside that shelter component was overnight stay or temporary shelter, away rentals, hotel rates, RV rentals, those sorts of things were significantly higher than expected and pushed the overall number up some, indicating that folks are traveling a bit. When you look at the month-over-month number, it was up 0.4% month over month. 0.3% was forecast, so 1 percentage point hot in that regard. And then on to producer price index. This is a measurement that's more weighted towards the wholesale side of prices. It was up 0.5%. 0.3% had been forecast, so that was significantly hotter than expected, y'all. Year over year, it's up 2.2%. It was expected to be up 1.6%. So again, significantly higher than expectations at the wholesale level. Add to that the fact that we've had a lot of debt issuance come onto the marketplace for auction. We saw a 10-year bond auction yesterday that was much weaker than expected. We saw a 30-year auction today that is also much weaker than expected. We are seeing bonds selling off sharply due to the fact that we don't have enough demand showing up at that 30-year auction today. And that really is moving well beyond the geopolitical risk that was encouraging some folks to buy bonds. We're actually seeing just the opposite with the weakness of that 30-year treasury. So kind of a mixed bag with reports, y'all. I do think it would have been worse were it not for the geopolitical unrest. But as that issue gets controlled, assuming it gets controlled, and of course let's all pray that it does, these numbers are going to start sinking in because it's fair to say that the Fed's going to look at this and see that they have more work to do. In any event, that's where interest rates are. I just realized I haven't given you the numbers yet. Mortgage News Daily has us at 7.65 today in a 30-year average for a conforming loan. 7.69% is where we were a week ago, so we're right back to where we were last week. 7.25 is where we were a month ago, y'all. So we're up just under a little over 3/8 of a point in the last 30 days, which is significant. But it's worth reporting that we were at 7.81% in that same survey back on the 6th of this month. So we're still better than the worst that we've seen this month, but not by much. And after today's movement, we may be right back in those 7/8 territory. Freddie Mac has us at 7.57. Mortgage Bankers Association has us at 7.41, although that MBA survey is about a week old at this point. So that's where we are on interest rates, y'all. More rocky roads ahead, no doubt. But I just want to give y'all a report on where we are at. One good bit of news, that is that Fannie Mae has finally revised what it takes to buy an owner-occupied duplex, triplex, or fourplex. So a multifamily property. FHA has kind of owned the market on somebody buying a unit and then living in the other side. You can do that with a VA loan as well, and the same low down payments on those programs apply. But on the Fannie Mae side, they've always required a 15% down payment, even if you're going to live in a multifamily property. Well, they've revised that now. You only need 5% down, effective mid next month, to buy a multi-unit property through with a standard conventional Fannie Mae loan. So that's very good news. In any event, I hope this information is helpful for you and for your clients. As always, you've got my numbers on the screen. We're always blessed to have your referrals. I'll keep an eye on it for you. More to follow next week. Y'all stay blessed.